something unusual is happening beneath the surface of the global financial system. At first glance, everything looks normal. Stock markets are still climbing, corporate profits appear stable, governments continue borrowing trillions of dollars. But behind the scenes, something has changed. And according to one of the most disciplined investors in history, the early stages of the greatest financial collapse the modern world has ever seen may already be underway. That investor is Warren Buffett. Now, understand something important. Buffett is not known for dramatic predictions. He has spent more than 6 decades building one of the most successful investment records ever recorded. Through wars, recessions, bubbles, and crashes, his strategy has always been simple. Stay calm, avoid hype, and pay attention to the underlying fundamentals of the economy. That is why when Buffett quietly begins repositioning billions of dollars inside his empire, people across Wall Street start asking questions. Because historically, when Buffett prepares for storms, those storms often arrive. Right now, investors around the world are noticing something unusual. Cash reserves inside Berkshire Hathaway have grown to historic levels. Several major investments have been reduced, and Buffett has repeatedly warned that markets may be far more fragile than they appear, which raises an uncomfortable question. What exactly is Warren Buffett seeing that the rest of the market might be ignoring? Because if his concerns are correct, the next financial crisis will not look like the crashes we have seen before. It could be larger, faster, and far more disruptive to the global economy. Over the next few minutes, we are going to break down exactly what Buffett may be signaling. We will look at the warning signs appearing across the global financial system, the massive debt structures that have quietly built up over decades, and the growing number of economists who believe the next economic shock could be historic in scale. But before we go deeper into the numbers, imagine something for a moment. Imagine the global economy as a massive dam holding back an enormous reservoir of water. For years, engineers have reinforced the structure. They have patched small cracks, they have added new barriers, and every time pressure built inside the system, they released just enough water to keep the dam standing. From the outside, everything looks stable. The wall appears strong, the water level remains controlled, and people living downstream continue their daily lives without worry. But over time, something dangerous can happen. Tiny fractures begin forming deep inside the concrete. At first, they are invisible. Then, slowly, the pressure inside the reservoir begins to widen those cracks, until one day, the engineers realize something terrifying. The structure was never designed to handle the amount of pressure now building behind it. That is the situation some economists believe we may be approaching inside the global financial system. And it is exactly the kind of environment Warren Buffett has spent his entire career preparing for. So here's the question. Do you believe the next financial collapse has already started? Or do you think markets will continue rising like they have for the past decade? Let me know what you think in the comments. Because when we start looking closely at the signals Buffett might be watching, the picture becomes far more complicated than the headlines suggest. To understand why Buffett's warnings matter, you first have to understand who he is and why markets have followed his moves for generations. For more than half a century, Warren Buffett has been known as the Oracle of Omaha. His investment philosophy helped turn Berkshire Hathaway into one of the largest corporations in the world. While many investors chase trends or react to short-term market movements, Buffett focuses on something different: long-term value. He studies businesses, he analyzes economic cycles, and perhaps most importantly, he watches how human psychology behaves during periods of fear and greed. This approach allowed him to navigate some of the most turbulent financial events in modern history: the crash of 1987, the dot-com bubble in the early 2000s, and the global financial crisis of 2008. During that last crisis, when banks across the world were collapsing and markets were in free fall, Buffett did something unusual. He stepped in. His investments helped stabilize companies like Goldman Sachs and Bank of America. Those moves earned billions of dollars and reinforced Buffett's reputation as someone who could see opportunities where others only saw panic. But today, Buffett appears to be taking a different approach. Instead of aggressively buying during market volatility, he has been quietly building cash reserves, enormous cash reserves, which raises another critical question. Why would one of the greatest investors in history prefer holding cash instead of investing it? Because in the world of investing, cash is not just idle money. Cash is ammunition. It's what investors hold when they believe opportunities may soon appear, or when they believe the current market may be overvalued. And when we examine the broader financial environment today, there are several warning signals that may explain Buffett's caution. One of the biggest is the extraordinary level of global debt. Governments, corporations, and households across the world have borrowed unprecedented amounts of money over the past 2 decades. According to international financial institutions, global debt now exceeds hundreds of trillions of dollars. Much of that borrowing was encouraged by years of extremely low interest rates. Cheap money fueled economic growth, it boosted stock markets, and it allowed governments to finance massive spending programs. But as interest rates rise, the cost of maintaining that debt becomes far more difficult. And when debt levels become too large, even small economic shocks can trigger major financial stress. This is where the situation begins to look more fragile. Banks are facing pressure from higher borrowing costs. Commercial real estate markets are showing signs of strain, and several regional banking institutions have already experienced sudden collapses in recent years. Each of these events may seem isolated, but together they form a pattern that economists are watching very closely. At the same time, stock market valuations in many sectors remain historically high. Technology companies have driven enormous gains in major indices. Investors continue pouring money into markets despite growing economic uncertainty, which leads to a split in opinion among financial experts. On one side, optimists argue that modern economies are resilient. They point to technological innovation, strong corporate earnings, and continued consumer spending as reasons the system will remain stable. In their view, short-term volatility is normal and long-term growth will continue. But on the other side, pessimists see something very different. They see a financial system built on decades of expanding credit. They see governments struggling with rising debt obligations, and they see markets that may be pricing assets far above their true economic value. From that perspective, the conditions for a major correction may already exist, and if that correction begins, the consequences could ripple across the entire global economy. Which brings us back to Warren Buffett, because when we analyze the strategic decisions he has been making recently, some analysts believe they may reveal how he sees the road ahead. Buffett has always believed that markets move in cycles. Periods of optimism are often followed by periods of fear, and when those cycles shift, the opportunities for investors can be enormous. But those opportunities only appear after the system experiences stress. That is why Buffett's growing cash reserves are attracting so much attention. They suggest he may be preparing for something large enough that having hundreds of billions of dollars ready to deploy could become a strategic advantage. And if that moment arrives, the investors who are prepared may find themselves positioned very differently from those who assumed the good times would continue forever. But what exactly could trigger such a shift? To answer that question, we need to explore the 3 possible paths economists believe could unfold if the current financial pressures continue to build. And depending on which path the global economy takes, the outcome could range from a manageable slowdown to something far more historic.